DoorDash on Wednesday became the latest company to announce widespread layoffs, a victim of a sudden drop in demand from inflation-wary customers. The food delivery service, which had gone on a hiring spree at the height of the health crisis to cater to those stuck at home, will now cut 1,250 jobs, or 6% of its workforce, to control ballooning costs. The announcement came the same day CNN said layoffs were underway at the network, and a day after fellow media company AMC Networks said it would cut 20% of its U.S. workforce. And after weeks of layoff announcements from a range of companies, from big tech's Meta Platforms and Amazon to big banks Barclays and Goldman Sachs. Nancy Daoud is a private wealth manager for Ameriprise Financial.
You're going to see this across the board. There will be substantial layoffs. The reality you're hearing from a dollars and cents point of view is inflation is cutting into corporate profits.
As for DoorDash, its CEO said in a memo to employees that, quote, "We were not as rigorous as we should have been in managing our team growth," adding, quote, "That's on me." The company's shares, which have fallen more than 60% this year, were up in early trading.
What we're seeing is that the holiday season has actually started much earlier.
Right.
I think there's a couple of reasons for that. I think the consumer is still worried that they can't get the things that they want, so they were going earlier in terms of what they were buying. What we're seeing also is from businesses, they've got a lot of inventory, so they want to get that out. And so this Cyber 5, it was Black Friday, now grown, we've got Giving Tuesday, and we're seeing that there are more and more deals. And so we're helping, obviously, to connect advertisers to be able to reach the people that matter to them. One of the mantras that I use with my team is sometimes it can all feel a little bit overwhelming with that laundry list that you spoke about. But actually think about what you can control. Control what you can control and start there. Don't see the whole thing as a big amorphous mass, kind of break it down in different ways.
This year, the amount of proceeds raised is down by about 93%. The amount of companies that have come to market this year relative to 2021 is down by 85%. So clearly, it has been a record in the reverse direction in terms of IPOs coming to market. The reason companies aren't coming to market isn't because the public market currency isn't strong. In fact, our pipeline is tremendous. The reason companies aren't coming to market is because of all the volatility in the market. They don't know what they are entering into, either on their IPO day or, importantly, the weeks and months that follow that IPO. The pace at which the Fed is increasing interest rates is, something that is at levels that haven't been seen, if ever, if not, certainly in recent memory. So companies very much want to go public. They very much want to go public. They are just all waiting for the volatility in the market to calm down. And, I always say, the key barometer there is you look at the VIX. If the VIX is above 20, you're not going to see a lot of IPOs. The VIX has been consistently above 30 this year.
After imposing the fastest increases to interest rates since the 1980s, Federal Reserve Chair Jerome Powell said Wednesday that the central bank may be ready to scale back the pace of rate hikes in its fight to tame inflation, possibly as early as next month.
It makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting.
Powell made those comments on Wednesday in a speech to the Brookings Institution think tank in Washington. But while the Fed is considering smaller rate hikes moving forward, perhaps 50 basis points instead of 75, Powell said the fight against the fastest outbreak of U.S. inflation in decades was far from over.
We will stay the course until the job is done. Despite the tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation.
With a 0.5 percentage point increase expected at its December meeting, the Fed will have lifted its overnight policy rate from near zero in March to the 4.25 to 4.5% range, the swiftest change in rates since former Fed Chair Paul Volcker was battling an even worse rise in prices. Higher rates have made home mortgages and other forms of credit more expensive for consumers and businesses. It has not, however, caused any appreciable impact on the U.S. job market, which remains robust. It has also had no convincing impact yet on inflation, leaving many to wonder how long the Fed might have to keep up the fight. Still, Powell's remarks ignited a robust rally in equity and bond markets, which have taken a pounding this year on the back of the Fed's aggressive rate hikes, with investors hoping that smaller rate increases, and eventually pausing them altogether, might come sooner rather than later.
Wall Street ended sharply higher across the board on Wednesday as investors barreled into stocks after Federal Reserve Chair Jerome Powell said the central bank might soon scale back the pace of interest rate hikes. The Dow gained 2%, the S&P 500 gained 3%, and the Nasdaq soared more than 4%. While Powell gave investors a reason to buy, he also cautioned that the fight against decades-high inflation was far from over and that key questions remain unanswered, including how high rates will ultimately need to rise and for how long. Ryan Bellinger, founder and managing principal of Claro Advisors, said that while investors reacted favorably Wednesday, he still thinks the Fed is a major risk factor for stocks.
If you're buying into this market, you are fighting the Fed. The Fed is trying to slow the economy down. They need to do this to get one of their mandates back into control. And so, to me, I don't want to fight the Fed.
Among the big movers, Tesla shares surged after reports that its sales in China in November were boosted by price cuts and incentives. Biogen jumped after its experimental Alzheimer's drug was shown to slow cognitive decline in a closely watched trial. Meanwhile, mega-cap tech stocks Nvidia, Microsoft, and Apple also posted strong gains.